Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest on our show, and he is Alasdair Macleod of financeandeconomics.org, and he's also the head of research at GoMoney. Thanks for finally coming on a podcast, Alasdair.
Oh, it's very much my pleasure, Jason.
Great, and we're happy to have you, and you're out there in England, and this is a real treat for our listeners because we don't get that many foreign guests on here. We have a lot of American portfolio managers and economists on here, so it's good to have a European perspective.
I'll try and give you a different view of the world, perhaps.
That would be great. I'm sure our listeners would love it. Okay, so let's dive in here to the first question. Why do you think governments, academia, and most of Wall Street are still obsessed with and still vehemently believe in Keynesian economics despite its horrific track record in the real world?
I think it's partly historic in that when the marginal revolution occurred back in the 1870s, William Stanley Jevons, who founded the Cambridge School of Economics, was obviously English. You had World War I. English became the language, well, firstly, it was the language of the empire and then the language of the world. And so the latest economic advances, if you like, in English were naturally the ones that were adopted around the world. It wasn't quite as straightforward as that because what Keynes was saying was so against the understanding of people in commerce and business that it actually took a long time for it to be accepted. And I would say that it never really was accepted until fairly recently, that what Keynes was saying was valid. But I think the second reason that Keynes was sort of so loved, if you like, by governments is simply that he shows a way in which governments can justify intervening in the economy. And if you've got some sort of intellectual justification for doing that, it does make life a lot easier. And I think, put another way, governments would rather speak to an economist who says, yes, you can do that, than speak to an economist who says, if you do that, you're going to come unstuck. And I think that was really the great attraction of Keynes to politicians and governments.
Exactly, and that's a point I definitely agree with, because one thing, after studying a lot of Keynesian economics and studying it through the Austrian lens, I mean, I haven't studied it through the Keynesian lens. I wasn't a trained Keynesian. I studied it through the Austrian perspective, and you just see that it goes hand in hand with politicians. So if the politicians give the economists an order, if they say we want this program, the Keynesians then come up with a model or an equation to figure out how to intervene in the markets to fund the spending somehow.
Exactly. No, that's absolutely right. And I think by the same token, this is why the Austrians have been really ignored. And I mean, they've been ignored, they've been sidelined so much so that very few Keynesian economists actually seem to be even aware of the Austrians.
This is true. I actually got in an argument yesterday with a self-proclaimed neo-Keynesian, and I made the assumption that this guy had never read von Mises, Hayek, or Rothbard, and this guy was actually a rare exception that actually admitted to have reading it, and he said there was some thought-provoking stuff in there. So, normally with a Krugman or a Ben Bernanke or some of those types, you're not going to have those guys who have read any of the stuff that you and I have read.
No, that's very, very true. Mind you, I think if I was in a position of authority now, like a central banker, given that there is actually nothing you can do, it's becoming black and white. Either you follow the Keynesian line and keep your fingers crossed, or you face up to reality and the whole thing falls down. What do? You cross your fingers and hope it won't fall over. And I think that's really where we've got to with the way economics has progressed.
Yeah, it seems to me that all the Keynesians can really do at this point is try to keep things in some sort of state of stagflation. And, the private sector, some of it is deleveraged and some of it is not, but, the governments have just ramped up the spending because that's how Keynesian economics is, with the counter-cyclic thing that if the private sector contracts violently, then the government sector should ramp up spending. But, it's not helping out create jobs. I mean, it's just wasting capital and resources. It's causing higher prices in commodities, and then it's creating potential Arab Springs all over the world.
Yes, I think that's right. But this really springs from a fundamental misunderstanding. The Keynesians never understood prices, which of course is at the root of all economics. And when something happens that they don't understand, a price effect, they put it down to animal spirits. But it's not animal spirits. There's no such thing as animal spirits in the sense that there is always an explanation, if you come at it sensibly, for what happens. And I think a very good example was what happened when we had the banking crisis back in 2009. You had a sudden switch from a world where credit was easily available and banks were very happy to lend money. In fact, they would even press you to go and borrow it. And it switched overnight into a world where banks didn't want to take any risk lending any money to anyone who needed it. And that, of course, changes in an instant the relative valuation between money and goods. And so if you look at it another way, really what the banks, the result of the bank's actions was to make the prices of all the goods and services too high. Suddenly they needed to adjust downwards. And but if you adjust the prices downwards, then obviously there are the implications for businesses that are making those goods and providing services. If they are unable to respond to that new environment, then they go bust. And generally, because they are over-leveraged with bank credit, many of them would go bust. And that was really what the Keynesians and the politicians have tried to prevent happening. But the analysis is quite simple. It's not animal spirits. It's just the change in the, if you like, in the availability of money has just changed the complete price structure. Prices became too high. And if you understand that, then you can begin to deal with the problem. But they don't even get to the point of understanding it. And instead what they do is they just chuck more money at the problem, hoping that it will resolve it.
Exactly, and it's Keynesian Ponzi bubble economics. I mean, they like to blow up bubbles. They blew up the real estate bubble. Greenspan papered over the tech bubble. I don't know what the Europeans have done in the past exactly. That's not something I've studied as much as the American economy in the last decades. But the Keynesian solution just seems to be that, when there's a problem, instead of allowing free market forces, instead of allowing the debts to purge, firms to go bust, which is what capitalism is supposed to be about, right? Capitalism is supposed to be about failure. That's not part of the Keynesian lexicon.
No, that's right, because, and here again, we're back to the interaction between economists and politicians. A politician who sees rising unemployment, thinks, my God, I'm not going to get re-elected. And so he turns to the economist for some help as to how to get out of the hole. And again, you get an economist who comes up with a solution, a government solution, he's going to be welcomed with open arms. So, there is no solution to this. And the trouble is that every credit cycle, the problem just gets worse and worse and worse. The distortions in the economy build up and build up and build up until finally the whole thing topples over. And that's actually what they're trying to prevent at the moment. And it's not just America, it's everywhere.
Yeah, they're really trying to manage the devaluation of the currencies, but they're playing, a fool's game here because they're trying to perception manage whenever they print money. They're just trying to prevent the velocity money and inflationary expectations so the inflation doesn't accelerate. So they're trying to control it and do a stagflation, but this is a fool's game in my opinion.
Yes, I think that's right. But we've now got to the point where all major governments are ensnared in debt traps. And once you're ensnared in a debt trap, you either face up to complete default, bankruptcy, or you try and print your way out of trouble. And that essentially is the only difference between what America is doing, what Britain is doing, and what Europe is doing. I mean, the Eurozone can't print its way out of trouble so easily because no single nation has its own currency. It has to go to the ECB in order to get money printing getting going. And the ECB is responding now. But the only salvation for a country like Spain, effectively, is, please, ECB, just print lots of money.
Okay, and I think you helped with the transition here. I wanted to switch gears to talk about the euro, and more specifically, let's start with Germany because Germany is such an important part of the euro. Some groups of Germans are pro-euro. You have the politicians and the German manufacturers who are pro-euro, and other groups of Germans are anti-euro. Do you think Germany can withstand leaving the euro, or would the capital inflows that would come in and drive up the value of the Deutschmark if Germany left the euro hurt German exporters too much and destroy their economy?
I personally think that Germany's got no alternative but to leave the Eurozone because of the costs involved of supporting the weaker members. I've interviewed two economists, one of which was leading the action before the German Constitutional Court, and they both confirmed with the figures that they were presenting the scale of the problem. Marcus Kerber, who was one of the leading lights in the Constitutional Court action, reckoned, and this is what he was presenting to the court, that the eventual cost to Germany of bailing out the Eurozone members would be 2 billion firm and another 1.7 billion in the pipeline. He was also including the international, the national central bank settlement system, the Target 2 system, where there's about 760 billion euros of debt has piled up on the Bundesbank's balance sheet owed by the other national central banks around the Eurozone. So that totals 2 plus 1.7, that gives us 3.7 trillion euros. Another economist, Philip Vargas, who is a professor of economics at San Pablo University in Madrid, reckoned it was around about 4 trillion. So we're talking the same sort of number. Now, to put it in context, the Germany's GDP is only 2.3 trillion. So what you're looking at is a situation where to bail out the countries in the Eurozone to the extent that we know today, and this is not looking forward to other costs going on, it's going to require over 100% tax on each man, woman and child in Germany. It's just not on. It can't be done. And the trouble is that, 4 trillion, where does it stop? It's not going to stop there. It's going to get worse and worse. And that is even before we talk about France, which seems to be in the process of destroying her economy with a socialist death wish, which is just completely nonsensical. So really, I think that the sooner Germany wakes up and thinks, well, we've just got to get out of this, the better. Now, you referred to the problem of a rising Deutschmark. In the short run, a rising Deutschmark does hurt business, yes, of course. But when things even out over time, it doesn't hurt business. And German industry has been perfectly capable of living with a strong Deutschmark in the past. We've had this situation which the Keynesians don't understand, both in Germany and also in Japan, where a rising currency doesn't seem to adjust the trade surplus out of a country's balances. It's quite simple why. But the short answer is that if you have an economy that is driven by savings, which is really the characteristics of a hard currency economy, then you have an economy that is productive. If you have an economy which is driven by consumption at the expense of savings, where savings are destroyed, then you have an economy that is collapsing in the longer term. And that essentially is the difference between where Germany should be and where Germany is being forced to be.
And those are great points, and that goes back to the discussion we had earlier about one of the differences between Keynesian economics and Austrian economics. And the Keynesians thinks that consumer spending, that boosting demand, drives everything, and you can't consume before you produce. Otherwise, you can do it over the short term, I guess. You can run a credit card debt, but if you do it over the long term, you're going to end up like a subprime borrower, and you're not going to have anything, and you're going to be a serf.
Well, again, it goes back, Jason, to a complete misunderstanding of what prices are about. And, Karl Menger worked it out pretty well, and that is that prices are purely subjective in the mind of the consumer. The consumer decides what he's going to buy, and he decides what he's not going to buy. And no one, unlike Stanley Jevons, no one can actually turn around and anticipate in the future what a consumer is going to pay and for what. The only people who can get close to it are entrepreneurs who put their money on the line. They develop considerable skills in order to succeed in doing this, and they anticipate what people are going to want. And sometimes they fail, but where they succeed and they continue in business, it is because they get it right. The government hasn't got a hope of doing that. It's got completely the wrong terms of reference. And the point about prices, coming back to prices again, is that because prices are entirely subjective, the prices of all the capital equipment and everything else that's required to produce those products are actually determined by what the consumer will pay, not by some sort of marginal cost theory. And this is where the Keynesians go so wrong. If you follow marginal cost theory, then obviously you can then start thinking that, well, because costs can be calculated, then it is not too difficult for government to begin to work out how to replace savings as a means of driving the economy forward. But the whole thing is wrong because they misunderstand how prices are formed in the first place. They are purely subjective, and the only way an economy can progress is because of that interaction between consumers buying what they want and not buying what they don't want, and entrepreneurs anticipating that. That is economic progress, not government bureaucracy intervening in the process.
And savings is also freedom. I mean, without having savings, I mean, you're forced to become a worker at, your options are very limited. You can't leave the country and go look for a better opportunity. You can't choose basically which job you want to work. You can't put your investments into something and maybe you can find a high-yielding investment like a Canadian Energy Trust or something like that, and then maybe not have to work. So this whole thing, this whole mindset has really destroyed the mindset in the United States and in Western Europe, I think, to save.
I think that's true, but there's also the financial effect, because what governments have been doing with building up the welfare state is they have been discouraging savings, and they've been telling the electorate, people, workers, serfs, whatever you like to call them, that we will look after you. And the result of that is that they destroy savings, and then they cannot provide a replacement for it because it is just not affordable. And that is precisely the position which every Western government has got itself into now. And, there is no way out of it other than bankruptcy.
Very, very good. Now, Alasdair, since you're in the UK, I have a few UK questions here, so hopefully you can help out some of our listeners who don't understand this. Our listeners are very big gold and silver bugs, and the Bank of England is known for doing one of the foolish things in the last, 15 years. They sold their gold at the bottom. So why do you think Gordon Brown and the Bank of England sold all of its physical gold holdings about a decade ago, almost at the exact bottom of the gold market?
Yeah, well, they sold actually about half their gold holdings, not all of it. And the reason for this is that it's quite sad in a way. Gordon Brown knew nothing about economics. He then found himself in the number 2 slot in opposition with Tony Blair as the leader of the opposition, and he was shadow chancellor. Now, at that time, there was a young man who was a journalist at the Financial Times who had trained at Yale. He got a degree, an economics degree in Oxford. He got an economics degree in Yale. And he came back, and he's a real hotshot. Now, this guy was a fellow called Ed Balls. He became Gordon Brown's chief economic advisor and taught Gordon Brown everything he knew about economics. Ed Balls subsequently became an MP and then a minister in Gordon Brown's government. It was Gordon Brown who was educated by Ed Balls in, if you like, almost Krugman-like Keynesianism. It was the absolute justification for socialist behavior. Accompanying that baggage is a complete anathema to the idea of gold. The gold standard being the barbarous relic and all that sort of stuff which Keynes trotted out, and he was really going along with that. He was, he was in the grips of, if you like, Keynesian enthusiasm, and he thought, right, the thing to do is we sell that gold. He also encouraged the IMF to sell part of his holdings, so that in return for gold, he would get money, which he could then provide in soft loans to lesser developed countries, and that was the source of the IMF sale. I mean, it was completely destructive. He sold half this country's gold right at the bottom. I mean, it was in varying prices between $250 and $300 an ounce. And look at us now. We're knocking on 1,800. I mean, it's really pitiful.
Yeah, I'm sure there was some people. There was a long line of smarter money who was willing to buy up the physical gold at that price.
Well, of course, isn't there always?
Yeah, so let me go down my question. Let's talk about the UK economy here. Our listeners are not that familiar with the economy in the UK. Is the real economy there stuck in a similar stagflation, similar to a lot of the developing world?
Yes, precisely. I mean, you say stagflation. Yes, I mean, we do have inflation. We've had higher inflation than, on official statistics anyway, than America has. So that is now coming down, and I think we're back down closer to the sort of 2% level. The economy is going nowhere. It's exactly the same problem as anywhere else. We've got, government finances have got out of control. The only blessing is that QE, this is from the government's point of view, QE has pushed interest rates down so that the government can actually borrow at very, very low levels. So the legacy in terms of interest rate payments on the government debt being created at the moment is at least sort of controllable. But that's not a situation that's going to pertain forever. And if you look at the underlying economy, it isn't really going anywhere. We've got a coalition, and I doubt if it was be very much different if Conservatives actually did have absolute power in government, or an absolute majority. But the effect of the coalition is to increase taxes for social reasons. In other words, we think it's unfair that the rich have money, so we're going to take it off them. And it's time they made their contribution to the poor, the undeserving poor, and all all this sort of stuff. So, but if you
same thing,
exactly
same thing going in the U.S.
Exactly, and I mean I won't need to tell your listeners that if you're going to disincentivize the wealthy and the entrepreneurs and so on and so forth, then you're not going to get any economic recovery. It's actually as simple as that.
And that's why a lot of entrepreneurs in the Western world, especially in the United States, if they have one winning company, they're looking to start filing their dual citizenship papers or forfeit their U.S. citizenship and go to Singapore or a more free country with less taxes.
Yeah, no, exactly that. And, you end up spending your waking moments trying to legally avoid taxes, rather than devoting your energies into producing new wonderful things which advance the economy. But politicians, they are so weak, they cannot even steer their electorates in a direction which half accepts that truism. And that is the thing that is so sad about it all. I mean, a good politician is someone who is ahead of his electorate and steers his electorate in the direction which is required. But I don't see any politicians in the world being able to do that.
Yeah, I just see politicians focusing on lying, and they're rent-seeking. To use an economic term, they're just parasites, and they're focusing all on the short term instead of, like you said, doing what is necessary for the long term to ensure, a better recovering economy. Well, and the statistics that we have now, all the real underlying economies in the Western world are not recovering at all.
No, that's right, and. But, we've got to a situation now where things are so dire. As I said, we're in a debt trap, and, no politician wants to have that spring on his on his watch. And, that's where we are, I'm afraid.
Okay, I just have one final question here. How much longer do you think the global central bankers and the Western politicians and even the developing world can continue devaluing their currencies before we have some sort of currency crisis and this world financial system potentially collapses.
Well, I think that there's sort of two questions in there. I mean, the currency crisis, I think, well, we'd be lucky if we avoid one by the year end. I certainly see a currency crisis next year. The final collapse, if you like, and we better define what we mean by a final collapse, and that is, in my mind, the complete loss of purchasing power for paper currencies, a collapse back to their intrinsic value, which is zero. Then I think that it's difficult to see how we can avoid that for more than 2 years.
Yeah, I think in 2015, the statistics are that the developed world, so like the U.S., U.K., Japan, and the EU, they need to roll over $15 trillion in debt. So I don't know. Obviously, there's no savings to be able to afford the debt, which means then the central banks are going to have to step in and monetize all of it or almost all of it, and China can't really buy up the U.S. debt or help that much with other debt because China has a lot of problems now too. So I think this game we're approaching endgame sometime around 2015, but they might be able to push it a little bit after that, depending upon like how they can manage, I guess, people's inflationary expectations and velocity of money, because there's still a lot of, I guess, sheeple out there that just don't understand all the inflation that's occurring and their purchasing power losing, and they're blaming it, on corporations, on companies, when for the company to stay in business, I mean, they have to if they're a restaurant, they have to cut the portion size to stay in business or the firm's going to go under.
Well, that's right, Jason. I think there is another point which your listeners should be aware of, and that is that there is not if you like, a direct link in any way between the presumed value of paper money and its quantity. We like to think of the quantity theory of money, which is actually a rough summation of what happens when gold is money, when you've got sound money. But with paper money, because you have no intrinsic value, in other words, one side of the monetary equation is totally meaningless, then that cannot apply. Now, the consequence of that is actually quite frightening, and that is that instead of, let us say, being able to anticipate price inflation in the sense that you see money quantities rise and rise and rise, and you think, okay, there's going to be a bit of a lag, but it looks to me as if that's going to start hitting the economy and prices, say, X months or X years ahead, then that is actually not valid. What is more valid is a scenario where, of a sudden, currencies collapse. There is no reason why they can't collapse very, very suddenly. Technically, what happens in a situation like that is people start discarding currency in return for goods because they realize that the currency is losing all its value. Now, if we refer back to the one case which was really well documented, and that is the German hyperinflation of 1920 to 1923. That final phase, that final collapse of the currency, took 5 months. It started, by my reckoning, in about May or June 1923, and by November it was all over. So the determinant in terms of time was that because you didn't have electronic banking or anything like that, things moved by paper, by check, or by cash. And if you had cash in the bank account, you couldn't go out in the street and write a check because it took 3 days to clear and money was going down so rapidly no one would take it. They wanted cash. So what happened was you had to cash your deposits, your checking accounts, in return for physical cash notes. And this meant that there was a massive increase in demand for paper currency. And the printing presses were working 24 hours a day, 7 days a week, and all 19 of them in Germany, and they were still not producing enough money. This time round, we actually have electronic money, we have credit cards and so on and so forth. So when the final collapse comes, it's not going to take 5 months. It's going to happen a lot more quickly. So just to warn, I mean, let's hope this doesn't happen. But what I'm saying is that if it does happen, it's going to happen a lot more quickly than you think. And one of the reasons it'll happen a lot more quickly than you think is that most people think there is a fixed relationship between quantity of money and prices. That is fundamentally wrong.
Yeah, this is a good point, Alasdair. And I want to make sure for our listeners that we don't want to be doom and gloomers, but we want to make sure our listeners understand what the facts are, not what the stuff that comes out in the mainstream media or the mainstream financial papers is, all these spun data. It's important that people have the facts of the stuff of the economy and what's going on in the world, and then they can make well-informed investing decisions or saving decisions, go out and buy physical gold and silver bullion, et cetera, and prepare for a scenario like the one that Alasdair just described.
Yeah, no, I think that's very fair, Jason. And I mean, this is what we do at Gold Money. We provide custodial services for precious metals outside the banking system, and it's for people who just want to take a bit of insurance against the worst happening.
Great. So please tell our listeners, Alasdair, again, about your other website and any of your other ventures that our listeners might be interested in, and if they want to contact you.
Yep. Well, I run my own website, which is financeandeconomics.org. That's org.com, which at the moment is actually being redone. So what I'm putting on there tends to be, sort of blog stuff, which is really articles I've written mostly for Gold Money. And you can find me on goldmoney.com. And I write the odd article as well for Chris Martinson's peakprosperity.com. So if you're members of that website, then you'll have come across my writings there as well.
Yeah, I really like Chris Martinson's work, Alasdair, and you do great podcasts on Gold Money too. I've been listening to a lot of them. I'm actually friends with Adam Kokesh. I live not too far from him. Around here in D.C.
Yeah, yes, a really nice guy. I had him on, I think it was about a month ago. Yeah, a really good guy.
Okay, well, hopefully, Alasdair, we can have you on soon again for another podcast. Thank you for your time.
That would be my pleasure. Thank you, Jason.